Hi, thank you for joining this mini webinar. It's going to be really crisp and short to the point webinar. Before we get into the presentation, let me just take a couple of minutes to introduce myself. I am CA nrajca, Chartered Accountant by qualification, a teacher, trainer by passion. I started my career as a banker, credit analyst with State Bank of India, worked for a period of 4 years. In very short period, I had the opportunity of becoming team leader, credit processing cell. So worked on 250 plus projects. It's 5,000 crore plus size. Then came out and started my CA practice, had my practice for a period of 7.5 years. Alongside had this teaching training. Thanks to technology, today through online, I teach 2 lakh plus students all over the world, basically on banking, credit and financial analysis, and majority of them are working banking executives. I'm really glad that my courses are helping them, and I'm sure this course will be relevant and useful for you as well. Let's get into the webinar. Let's understand how drawing power is calculated in case of cash credit facility. Cash credit facility is basically sanctioned against inventories and debtors. So the inventories have to be divided into three. It is raw material, work in progress, and finished goods. Then debtors. Now within inventories, the unusable materials or obsolete raw materials have to be excluded, right? So we'll say excluding obsolete or unusable materials. So they got to be excluded, and same is applicable for finished goods also. Now we have to attach the respective value. So let me capture the amount over here. Let's say the value of raw material in stock is 100 million. Work in progress is say 25 million. Finished goods is say something like 75 million. And debtors based on their working capital cycle is at say 125 million. Now the bank will not lend against all these amounts fully, because the bank would expect the owner also to contribute, and that they ensure by having a provision for what is known as margin. So first let's say what is going to be the margin in percentage. The bank will not fund against the entire raw material. Bank would expect the owner to contribute at least 25%. Same is the case for work in progress and finished goods, and that is going to be the more or less a common norm. Okay. Now, if the bank is expecting 25% contribution for inventories, when it comes to debtors, bank would expect the owners to contribute even more, because these assets are highly risky than these assets. Of course, it is highly liquid, but it becomes untraceable many times. So bank will not be in a position to lend 75%. It means by having a margin of 25%, the bank is lending 75%, but the bank may not lend 75% against debtors. Bank may lend at a lower rate, let's say 60%. It means the bank would insist on a margin of 40%. So let's calculate the margin amount now. Okay, margin amount. So how it has been done? It's 100 multiplied by 25%, 25, then 25 into 25%, 6.25, 75 into 25%, 18.75, 125 into 40%, it's 50. Now from this amount, if we deduct this margin amount, let me just correct this. If we deduct this margin amount, what we get is going to be advance value. So let me capture that here. Advance value. Advance value is nothing but this amount minus margin. So bank would be ready to fund 75 against raw material, because 100 minus margin of 25. Then with regard to work in progress, they would be interested in lending 18.75. That's nothing but 25 minus 6.25. Against finished goods, it's going to be 56.25. Against debtors, it's going to be 75. So let's total this. It's going to be sum of all this, and total is 225. So this is what the bank is going to lend for the current assets of 325. So if you're going to show 325 worth of current assets, bank would be giving only 225 as what is known as drawing power. Okay, so this is the drawing power, but let's not conclude it like this, because this got to be compared with the cash credit that has been sanctioned. Okay, so let's see what is the cash credit that has been sanctioned. Let's say the cash credit that was sanctioned is 250 million,
whereas the advance value what you have now is 225 million. Okay, advance value what we have now is 225 million. So now comes the exact role of drawing power. Drawing power is going to be the lowest of the above two. So you have to compare the cash credit sanction limit and compare that with the advance value, whichever is lower. So you have to go by lowest, that is advance value, and this is going to be the drawing power. It means only this fund will be released in CC limit even if you have the sanction limit as 250 million. So this is very important role of drawing power. So this is going to be the scenario one when you have higher limit but lower advance value. So the drawing is limited to the lower advance value. So this is the best part of a cash credit because the account is getting monitored, it is getting controlled, or it is getting regulated. Or just imagine a scenario, let's say scenario two. Okay, this is scenario one. We'll have scenario two where we'll say that cash credit sanction limit is 200 million. Okay, let's say it's going to be 200 million. Then you have advance value. What is the advance value? It is 225 million. So now which amount will be released? Sanction is 200 but advance is greater than the sanction. In that case again it's going to be whichever is lower, that is drawing power is going to be whichever is lower, that is it's going to be this 200. So even though if you have advance value, that amount cannot be released because the sanction limit is only 200. So this is the exact role of drawing power. Now in this drawing power calculation we have to keep two more things in mind. When the raw material are taken into consideration, we have to ensure that this raw material stock includes or does not include any unpaid materials. Because it is possible that you purchase raw material on credit and you don't pay for it, but you keep it in inventory and show it to the bank and get loan. That should never happen. So if there are any raw material included in this for which the amounts have not been paid, it means they are still on credit, then they got to be deducted. Okay, so let me just introduce two rows. So here I'm going to say less raw material purchased on credit. Let's say of this 100 I have raw material worth around 40 which are purchased on credit. It means the net raw material I should consider. Okay, net raw material stock which I should consider is only 100 minus this 40, that is 60. Okay, so here when I total it should be only 1 2 3 4, these four, because this is net figure. Okay, and with this net we should add all the four, and here we have. So let's shift the calculation from here to here. That is 25% margin, and margin amount is going to be 16 to 25% 15, and the advance value is going to be 60 minus 15, 45. So if you notice, the advance value has come down. Earlier advance value was higher, okay, but now it has come down to 195. And if sanction limit is 250 and advance value is 195, then drawing power would have been, will get reduced to 195. And in scenario 2, again when the sanction is 200 and advance value is 195, we have to go for whichever is lower, that is only 195. So that is one critical point that we have to keep in mind. And again, with regard to debtors, you cannot include all the debtors in your stock statement, because at the time of sanctioning the cash credit itself, bank would have stipulated a condition that debtors which are only fitting in the working capital cycle. Because in the earlier sessions we have said the company would have the practice, or the company may have the practice of giving 1 month credit or 2 month credit, and that should have been accepted by the bankers, and only those debtors should be included in the statement. So let's say the credit period is 90 days, and this 125 million includes 25 million worth of debtors which are above 90 days. Then those got to be excluded. Okay, so from this 125, I'm going to subtract 25 million worth of debtors because they are above 90 days. Why I'm removing? Because the bank has accepted only 90 days as the credit period. So what is happening here? Debtors is becoming 100, and if you notice, the advanced value has come down. Earlier the advanced value was 75, but now the advanced value is only 60. So accordingly, the advanced value is coming down. So drawing power will also come down.
Thank you so much. We have come to the end of this webinar, and I'm sure you would have really derived value from this short and crisp webinar. If you wish to continue this learning journey, I have an amazing opportunity for you. I have published several courses on banking and financial analysis area, each course costing 2000 rupees. But for you, I'm going to give you a special offer. Here we go. Banking credit courses bundle. This includes course number 1, banking credit analysis process. It's a comprehensive course with 200 plus lectures. It covers financial analysis, working capital, term loan, LC, BG. It's a comprehensive ever course. Then we have course number 2. That is how to carry out financial analysis as a banker. This is going to focus exclusively on financial ratio analysis, cash flow analysis, and fund flow analysis. Then comes course number 3, how to carry out term loan appraisal and analysis as a banker. It's a comprehensive course focusing on the technical aspects around project finance and term loan. These are all the topics. Then comes course number 4, how to prepare CMA report for bank loan through 8 sections. This course will take you through entire CMA report preparation process for bank loans. Then we have course number 5, how to read balance sheet. So if you are a non-finance person, this course will give you complete insight into balance sheet, how to read them, how to interpret them, how to analyze them. Okay. Then we have course number 6, how to read CIBIL report. By taking this course, you will get a complete picture of CIBIL report reading process. Then we have course number 7, how to prepare cash budget for bank loans. This course will help you to understand the concept of cash budget, which is widely used in short-term lending like auto credit facilities, letter of credit and all. So far I have introduced 7 courses of 1999 each. It means 7 courses of value 13,993, but you are going to get it only for 2,599, and it is not yet over. I'm going to give you some more bonus. Course number 8, collateral securities, a comprehensive study. Course 9, how to carry out credit risk rating for non-trading entities. Course number 10, in this course you will learn banking credit analysis through various case studies. So now it is 10 courses of value close to 20,000, but you are going to pay only 2,599. It is not yet over. Some more bonus. Course number 11, how to read audit report. Course 12, this focuses on letter of credit, and course 13 focuses on financial analysis in very short duration. So you have 13 courses of value close to 26,000 rupees, but you are going to get it for just 2,599. So it is basically 7 main courses, and you are going to get another 6 complimentary courses, 6 courses as bonus. So overall it is 13 courses of value close to 26,000 rupees. It's 1,500 plus lectures. You get lifetime access for all these pre-recorded courses. You can access them in desktop, laptop, mobile, iPhone, iPad, and the overall cost is around 26,000, but you are going to get it only for 2,599. So this is a once in a time opportunity for you. Enroll now. I'll see you inside the course. The link of the course I have given in the next lecture. So once you complete this video, just move on to the next lecture. You will find the link. Click enroll. I'll see you inside the course.